9,158 tons of gold sit in London vaults, valued around $1.467 trillion. That is not a typo. That is a pile of metal so large it rivals the economic output of major nations. And yet today, the price action looked like nothing. A stall, a pause, a market that, on the surface, refused to move. But here's what makes this moment dangerous for anyone only watching the chart. The last time gold did nothing while the plumbing shifted underneath, the repricing didn't arrive gradually. It arrived in bursts, not months, not weeks. In 48 hours, a quiet tape turned into a headline, and the people who understood the setup weren't reacting. They were already positioned in the only way institutions can be positioned, by the flows they leave behind. Because the strangest part of a gold stall isn't the lack of movement, it's the imbalance it hides. When attention is high, when macro narratives are loud, and when the world is stacked with reasons for gold to swing, a flat day is not normal. It's tension. It's compressed information. They said this kind of stall couldn't happen at scale. They said the gold market is too liquid, too deep, too efficient for a breakout setup to form in plain sight. And then, year after year, the same pattern repeats. Price calms down right when the real players quietly commit. The public sees boredom. The data shows preparation. What I'm about to lay out changes how this stalled today tape reads. Not because of a line on a chart, but because of the contradictions that only appear when you line up vault totals, official sector behavior, investment surges, and the subtle dislocations between paper signals and physical reality. Here's where it gets interesting. The breakout setup no one is pricing in is not a prediction. It's a mechanism, and the mechanism is already in motion. Welcome to Orion Ledger, where we decode what matters before it becomes the headline. If you like the feeling of hearing the quiet evidence before the crowd hears the loud story, you'll feel at home here. And if you want to be part of the conversation, drop a comment with where you're watching from. Because this market looks different depending on what currency you think in and what risks you live with. Now let's reconstruct what stalled today actually means. On days like this, the market's surface tells a clean story. Buyers and sellers met, neither overwhelmed the other, and price closed near where it opened. But beneath that surface, the gold market is not one market. It is a layered system. Futures, forwards, OTC swaps, ETFs, central bank reserve decisions, refinery, output, vault capacity, and the constant invisible choreography of settlement and collateral. When that system is calm on top and active underneath, something is being absorbed. In the last 12 months, the most revealing shift has been this. The identity of the marginal buyer has been changing even as the price keeps climbing. Official sector buying cooled from the previous breakneck pace, but it did not disappear. Central banks still added hundreds of tons over the year. At the same time, investment demand surged, not by a small margin, but by something that forces you to ask what changed in the minds of large pools of capital. And then you look at the vault base. London vault holdings, measured in tons and bars, represent the physical anchor for a huge portion of global gold trading. When that base is stable, it can look like the market is well supplied. When it shifts, even slightly, it tells you something about friction, availability, and the cost of turning paper claims into metal. So the central mystery of a stall is this. Why would price hesitate when demand regimes are shifting, and when the system is built to translate tension into movement? Because stalls happen when two forces collide at the same time. One force is momentum, the other is inventory. Momentum is the crowd and the models. It's trend followers, risk parity rebalances, macro funds, and systematic strategies that buy, because price is rising, and sell because price is falling. Inventory is the physical and quasi-physical reality that decides whether the market can deliver what it promises. When momentum wants to run, but inventory is being protected, price can pause while the contest is decided. This is not a new story. It's the hidden pattern that shows up right before the big moves. In 1979, gold didn't soar in a straight line. It surged, it stalled, it shook people out, and then it detonated higher as inflation fear, geopolitical tension, and loss of confidence in policy fused into a single trade. The stall phases were where the market transferred ownership from weak hands to hands that could sit through volatility. In 2008, during the crisis, gold initially fell with everything else, then stabilized, then began a multi-year climb. The stalls mattered because they occurred while the financial system was being rewired, and while central banks turned from ordinary policy into something that looked to a lot of capital, like a permanent experiment. In 2020, when the world froze, gold again showed that stalls can be deceptive. There were days where price looked tired, as if the move was over. But underneath, the demand for collateral and the scramble for deliverable metal created stress. Points that only later became visible in spreads, premiums, and the kind of scramble that doesn't show up on a simple spot chart. In 1979, the pattern was surging demand and broken confidence. Result: a historic spike that rewrote the public's relationship with inflation risk. In 2008 through 2011, the pattern was crisis, then policy expansion, then a prolonged revaluation of safety. Result? Gold marched to new highs as the concept of risk-free got redefined. In 2020, the pattern was systemic stress, supply chain friction, and an urgent need for reliable collateral. Result? Gold broke higher as the world rediscovered what settles when everything else is a promise. And in the current cycle, the stall is happening again, but with a twist. The players are more coordinated, the products are more complex, and the gap between paper liquidity and physical reality is wider than most people realize. Today's stall fits the classic template. The market arrived with an expectation. After a year of outsized gains, any hesitation would turn into a pullback. But momentum doesn't disappear in one quiet day. It transfers. The question is whether the transfer is from buyers to sellers or from impatient buyers to patient buyers. Look at the backdrop. Inflation narratives rise and fall, but the deeper driver is credibility. When real yields rise, gold is supposed to struggle. When the dollar firms, gold is supposed to fade. When risk assets rally, gold is supposed to become optional. And yet the last cycle has shown repeated moments where those supposed to relationships weaken. Not break forever, but weaken at key times. That weakening is the market whispering that the old playbook is being amended. This is why stalls matter more now than they did a decade ago. In the early 2010s, gold's peak and subsequent drawdown trained a generation to think of gold as a trade that ends in disappointment. Then 2019 reminded markets that compressions can be launch pads. Gold built a long base, bored people for months, and then moved through levels that had capped it for years. In 2020, it didn't just break out. It forced even skeptics to admit that when confidence is shaken, gold does not need a reason to be exciting to be necessary. Even the failure years are instructive. In 2013, gold didn't drift lower gently. It broke hard, in a way that punished anyone who assumed a stall meant safety. That is the other side of this setup. When compression resolves down, it is often because leverage positioning was too one-sided, and the system needed a liquidation to reset. The market doesn't care which direction hurts feelings. It cares which direction clears positions. So a stall is a fork. It can be the pause before continuation, or the pause before the trapdoor. The difference is visible in the evidence the next days and weeks reveal, whether declines find immediate heavy bids, whether rebounds are sold quickly, and whether the physical signals relax or tighten. Now add the geopolitical and balance sheet layer. Gold is not just a commodity, it is a monetary asset that lives outside another institution's promise. That makes it sensitive to something most market commentary avoids, the long-term debate about what safe really means. When public debt trajectories look permanent, when policy looks reactive, and when global trade relationships shift, gold starts behaving less like an inflation hedge and more like a credibility barometer. That's why a stall after a large move can be more bullish than a surge. A surge can be emotion. A stall can be acceptance. Acceptance is when the market absorbs all the reasons to sell and still refuses to break. That is when the breakout setup begins to form, not as a chart pattern, but as a psychological and mechanical reality. So who are the players right now? Start with the official sector. Central banks are not day traders. They don't chase candles. Their mandate is stability, reserves, and credibility. When they buy for years, often quietly. And they do it because they see vulnerability in the system they are paid to defend. When you see countries like Poland aggressively accumulating, it's not about a short-term price call. It's about reserve composition and the kind of insurance that does not depend on anyone else's balance sheet. And Poland is not alone. Across the official sector, the story has been diversification and resilience, even as publics. Narratives claim that the world is stable and policy is under control. Then you have the ETFs and the Western investment complex. This is the visible proxy for retail and institutional allocation in places where gold is held through paper claims and custodial structures. ETF flows can be hot money, but they also reflect broad shifts in portfolio construction. When ETF holdings rise during stalls, it signals that demand is being expressed even without a dramatic price move. When ETF holdings fall while price holds, it signals something even more interesting. Demand may be concentrated outside the most visible channels. Then you have the futures exchanges and the clearinghouses. This is where leverage and margin turn price moves into forced behavior. When margin requirements change, when volatility measures trip risk controls, or when liquidity thins at the wrong moment, the paper gold price can move in ways that have almost nothing to do with long-term fundamentals, and everything to do with who needs to post collateral by the end of the day. And finally, you have the physical chain. Miners, refiners, fabricators, bullion banks, and vault operators. This is where the market becomes real. A bar is either there or it isn't. A shipment either clears or it doesn't. And when the system gets tight, The dislocations appear in the places most commentators never mention. Now, the institutional movement that matters in a breakout setup isn't a press release, it's timing. When official sector buying remains substantial even after a multi-year surge, it tells you that the buyers are not satisfied. When vault data shows large, stable holdings, it tells you the system is stocked, but it also tells you how much is potentially spoken for, pledged, and used as collateral. The coordination is in the overlap. The stall happens when these forces meet at a point of maximum uncertainty, and the market has to decide whether to clear higher or force a reset lower. This is the part no one is discussing, the dislocation. There are always at least two gold markets at any moment. There is the paper market, which is deep, fast, and leveraged. And there is the physical market, which is slower, constrained, and governed by logistics, trust, and settlement. When those two markets tell the same story, gold trends smoothly. When they disagree, you get stalls, spikes, and sudden repricings that seem to come out of nowhere. The contradiction shows up like this. Price pauses, but physical metrics do not relax. Price pauses, but the official sector keeps accumulating. Price pauses, but investment demand swells. Price pauses, but the vault base signals that the system is not expanding accessible supply in the way a sleepy tape would imply. It's the difference between gold that exists somewhere and gold that is actually available at today's price, under today's terms, for immediate settlement. That gap cannot persist indefinitely. Either the paper market will drag the physical market into complacency through lower prices and reduced demand, or the physical market will force the paper market to reprice through tightness, higher premiums, and the kind of stress that makes leverage unwind. Historically, when physical tightness builds while price stalls, the resolution tends to be upward, not because of optimism, but because the system must clear at a price where supply can be coaxed out and where the cost of holding claims reflects the cost of delivering reality. Now let's put numbers on this so it stops being abstract. $467 trillion, with hundreds of thousands of bars accounted for. That is the physical foundation that a huge fraction of global paper gold references. 2. Central banks bought 863 tons in 2025. That is not a token amount. That is a strategic allocation at national scale, and it continued even after the previous years that crossed the 1,000-ton mark. The story isn't that central banks stopped. The story is that they stayed big, even as price rose, even as headlines said the trade was crowded. 3. Investment demand surged dramatically in 2025, rising by roughly 84% to about 2,175 tons. This matters because it means the marginal buyer shifted. When investment demand surges like that, it's telling you that the fear is not just inflation, it's confidence. It's the stability of assets that are supposed to be stable. 4. Large ETF holdings remain a sensitive pressure gauge. When the most visible Western gold vehicle holds well over 1,000 tons, it represents a giant pool of demand and potential supply. If those holdings trend higher during a stall, it suggests the stall is accumulation. If they trend lower while price refuses to break, it suggests an even stronger bid is absorbing supply elsewhere. And that brings us back to what the stall looked like. The tape was calm, but the context was not. When a market can digest both good news and bad news without giving you a clean, directional answer, it is often because the real trade is happening in size, quietly, in places that don't print in a candlestick. 5. The broader context is price behavior across 2025 and early 2026. Gold has already delivered a move large enough to attract every kind of narrative, yet it can still pause without collapsing. That is not typical exhaustion behavior. Exhaustion usually looks like sharp reversals, not quiet compression. So what does this mean? It means the stall is likely not the end of the story. It is a negotiation. And the negotiation is between the cost of paper leverage and the value of physical certainty. To understand the mechanism, you have to understand how pressure builds in this market. Imagine a theater where tickets are sold in unlimited quantity. That's paper gold. As long as most people are content to hold a ticket and never demand a seat, the theater can appear to have infinite capacity. But the moment a meaningful fraction of ticket holders decide they want actual seats, the illusion breaks. The theater must either raise ticket prices, limit sales, or face chaos. Physical gold is the seat. The ticket is the claim. In normal times, claims trade smoothly because delivery demands are predictable. In stress times, delivery demand spikes, and the gap between claim and metal becomes the story. How does a stall happen in that environment? It happens when the system uses tools to keep the surface calm while pressure redistributes. Margin changes can force leverage longs to reduce exposure without the price collapsing in a single day. Volatility controls can thin liquidity, making it harder for momentum to push price in either direction until a catalyst arrives. Dealers can widen spreads and manage inventory, slowing down the speed at which demand translates into spot movement. Meanwhile, the quiet actors do their work. Central banks allocate. large funds rebalance, physical buyers lock in supply, and the market prints a flat day that looks meaningless to anyone not watching the chain. Here's where it gets interesting. When the stall is a setup, you usually see one of two things next. Either a fast upside resolution as the market reprices the cost of certainty, or a sharp downside flush designed to break, positioning and refill inventories at better levels. The key is that the stall itself is not the conclusion. It is the loading phase. So let's map the forward scenarios the data suggests without pretending certainty. If the current pattern continues and official sector buying remains substantial, even at a slower pace, while investment demand stays elevated, history says the market tends to resolve higher after compression. That's the conservative scenario, a steady continuation driven by allocation rather than panic. If, on top of that, the paper versus physical dislocation widens, shown through tightening availability, rising premiums, or stress in settlement channels, history suggests the resolution can be sharper. That's the moderate scenario, a breakout that looks sudden but is actually the release of months of stored tension. And if a macro shock hits at the wrong time, something that forces collateral demand higher or undermines confidence in a major funding market, the aggressive scenario appears, a repricing where gold moves not because people like it, but because they need it as a neutral asset when promises are questioned. What should you watch if you want to know whether the stall is setup or exhaustion? Watch the relationship between price and flows. Does price hold while visible investment vehicles shed metal? That implies demand elsewhere. Does price stall while official sector behavior remains firm? That implies strategic buying. Does the physical base in major vault hubs remain stable or tighten? That implies the collateral function is being protected. Does volatility rise while price refuses to break? That implies pressure is building. And watch the moments when leverage is forced to reveal itself, when margin requirements change, when liquidity thins, when short-term funding rates jump, when risk assets wobble and gold refuses to follow them down. Those are the moments where the market tells you what it values. Now, here's the divide. One more signal often reveals the truth: the price of time. When gold lending markets tighten, when short-dated funding for metal becomes scarce, and when the market pays up to borrow ounces for delivery windows, it's telling you that available and deliverable are separating. You may not see it on a spot chart, but you can feel it in the way spreads behave, in the urgency of roll activity, and in the sudden sensitivity to small headlines. That is when a stall stops quiet and becomes combustible. Most people experience markets through headlines and charts. They see motion and assume it's information. They see stillness and assume it's nothing. But in gold, stillness can be the loudest signal because it means the market is absorbing narratives without conceding price. The difference is not intelligence, it's attention. Because time is expensive in markets. A flat tape when the world is loud is not free. Someone is paying to keep it flat, or someone is fighting to prevent it from moving. Institutions move first because they can. They have mandates, balance sheets, and the ability to act before the story is comfortable. Retail moves last because retail is invited in only after the narrative is obvious. That's not cynicism, that's structure. So when gold stalls today, the question isn't whether the market forgot how to move. The question is what tension is being stored and which side will pay to release it. This is Orion Ledger, where we decode what matters before it becomes the headline. If this connected dots you hadn't lined up yet, you know what to do. And remember, the real question isn't whether this unfolds. The question is whether the market forces the repricing, while most people are still staring at a flat day and calling it nothing.